All right, Jeff. First conversation in person for talking about volatility and the importance of volatility. It feels like Bitcoin is really benefited from max volatility that is brought to the market. But also now there's certain things about the volatility of Bitcoin that are enticing the institutional investors. And it's because volatility has been coming down. Talk a little bit of how you think about volatility, given kind of your experience with a bunch of derivatives and also generating alpha in this industry.
Yeah, absolutely. Most of us, I think, in the financial services industry are taught to be afraid of volatility or to think of it as something to be less desirable. But the reality is volatility, if harvested correctly, can actually be a very useful tooling for not just risk management, but also for yield generation. And at the core, Bitcoin's volatility is very much a feature. And it is really designed within its monetary construct as to the fact that there are really two trade-offs you can make in the design of money, which is that if you want price stability, you have to have quantity stability as the thing that you might have to trade away, which is the basic foundation of our monetary policy with fiat. But the flip side of this is actually if you fix the quantity, well, then by definition, the price has to be the outlet in which there is going to be volatility. And that is, in fact, a healthy thing. That is the natural design of what money can be. And so I think Bitcoin, it's garnered a lot of attention, mostly because of the volatility. In a way, that in itself is a bit of an attention economy in itself. And the reality is a lot of young people do gravitate towards volatility as a source of alpha, as a source of generating wealth that is not exclusive to just Bitcoin, in my opinion. It's actually fairly present in the retail investing world broadly, within the way that people want to express views on small market cap exposures, or event-driven risks that are coming into play by activism and whatnot. So I think the unique opportunity here is as institutionalization has taken Bitcoin to higher thresholds of ownership, what is the level of volatility that we can expect going forward? And there, I would say volatility is a nuanced definition and metric in itself. Most people think of volatility as the standard deviation in percentage terms of an asset's price, and that can be measured monthly, quarterly, yearly, etc. But it's a close-to-close observation. What it means is that it doesn't actually accurately capture intraday dispersion. So if a stock went up a bunch and then came down at 4 p.m. the same day, it would look like it's a zero vol asset. But we all know that was not a zero vol day. And intraday volatility in crypto is just as important as close-to-close volatility. So that's the first point I would mention about what's really unique about Bitcoin. And then the second thing is there's second and third orders of magnitudes with volatility measurement too. So for example, volatility exists in a range of distribution, but just because it steadily exists in that range of distribution in a normal and predictable way, doesn't mean it's not a volatile asset either, meaning the jump risks on the left and right tails also quite matter. So if something is steady for, let's say, a month where the volatility is 30, and then one day it has a 200 vol day, some might still say that average blended volatility is not very high, but you and I as humans know that was a volatile stock or a volatile asset or a volatile day. And the beautiful thing about Bitcoin is it actually exhibits a lot of fat kurtosis. There are days when Bitcoin gaps. This is when people get really excited and the volatility and spot relationship often changes during these moments of asymmetric performance. Today is actually a great example. Today's a great example that when Powell came out with his announcements on how he's redesigning and rethinking about the monetary framework for monetary policies, Bitcoin gapped. It was a big move.
112,000 to like 116 or so.
Yes, in a matter of basically minutes. And that is maybe not noticeable as a close-to-close rolling day observation of volatility on a daily, but on the intraday, if you are present for that price action, that was pretty important.
You think about Bitcoin close-to-close, there is no close, which I've always found very interesting too.
That's right.
So, if you go and you say, hey, what was Bitcoin's price at on a certain day? Usually in the stock market, people will look at what it closed at for the day and they can kind of mark it. There are some ways that people have tried to standardize this, looking at certain time periods, whatever. But the fact that Bitcoin never does shut off in terms of that price movement, do you think that makes it more volatile, less volatile, or does it have no impact in terms of in the stock market, you kind of pent up all this demand into the hours of operations, Monday through Friday, and when the stock market's open. with Bitcoin, it's really dispersed over, 24/7.
That's right. That's right. And I think you're hitting on something really interesting here, that all the quants, the Rentech, the 2 Sigma guys model every day and think about, which is that volatility by looking at price alone is actually not good enough of a signal. What you actually need is volume, because it's the combination of price and volume that can actually dictate whether there are trends or reversals. And when you look at kind of traditional market structure, you have huge trading volume at 9:30 to 10:30, and then you have huge trading volume between 3 and 4 p.m. That's generally when the activities take place. So it does make sense. People look at close to close for monitoring and modeling what they think are important attributes of volatility for stocks in this fashion, because that's actually what the volume is. Crypto is a little different, or at least it had been very different until institutional adoption of the ETFs, which is that volume can be dispersed. It can happen during US hours. It often also happens during Asian hours in meaningful ways. And that means 4 p.m. EST to 4 p.m. EST might not actually be when the volume happened for the observations you want to monitor. So a lot of times what you do see is quant strategies trying to model volatility using different time horizons where they believe the alpha actually sits where the volume is most proprietarily acute. And that's why I think even when you look at realized vol measures from Bloomberg versus Deribit versus Coinbase, they all spew different numbers, actually. You're precisely right that there's no standard metric here, but I think that's also why there's a lot of alpha. And the other point I would mention is more important than close to close volatility, in my opinion, is even if you want to use like a 24-hour window, the better version is actually knowing the spread between the highs and the lows of that day. We call this Parkinson volatility, but essentially that gives you the full range of actually the day's motion of the asset rather than just one point in time in that 24-hour observation window. This is not normalized in equities or fixed income markets, but I do think crypto is actually just such a unique asset that we are pushing the frontier of how to be more scientific.
Is there risks or opportunity associated with the fact that you have an underlying that trades 24/7 and then you have an ETF that stops trading at 4 o'clock? And obviously there could potentially be dislocation between Bitcoin goes up or down when the ETF is not accessible to these investors? Like, how do you think through both risk and opportunity in any sort of dislocation there?
Yeah, there's no risk in the sense of there being like a structural constraint that would cause operational issues on the ETF side. The ETF ultimately is a trust product that owns the underlying assets and reflects the NAV every day. I would also share today, actually, Bitwise had its first in-kind processing through the Bitcoin ETFs. And so we're actually experiencing what we've always wanted as an industry for a long time, which is the ability to actually build that bridge a little bit more seamlessly by permitting in-kind token contributions rather than just cash from the APs. So all of these are steps moving in the right direction to minimize potential choke points or operational breakouts. And I think that's ultimately going to create more seamless markets.
So, and again, I don't want the lawyers to get mad at us. So we have to be very careful about what we talk about. But I think that what you're saying here is there is internal operations where there can be an expanding for Bitcoin treasuries in general, kind of expanding the aperture. There is external operations, which really Strategy, Metaplan, and many of these companies have already done a great job in terms of pioneering and exploring, but there may be some other things that people will do there. And then there is this kind of financial services, the products and services built on top.
Right.
It's kind of the three things. One thing I want to talk about is you and I went back and forth quite a bit on, okay, what is the North Star? What is the metric that we care about? And I think that, when we came up with this idea of Bitcoin rate of return, people had started kind of talking about it, but I think you and I really were like, that's the thing. Mm-hmm. So much so that literally the ticker of the company that we've publicly announced is BRR, right? Bitcoin rate of return. Talk about like, what is Bitcoin rate of return to you? And like, why is it that you're like, okay, that's the thing that I think is the single most, North Star metric to focus on?
Yeah. I think it's so important that we start to normalize the possibility of measuring things in Bitcoin as a way to think about a benchmark for outperformance. It's very hard because we live in a very privileged country where dollars actually is very useful, very powerful, and day to day, it's the utility to which we measure by. But at the end of the day, even the dollar is not avoiding or inescapable from the general kind of fiscal dominance that is happening globally. And it's time for all investors and operators and people in the space here to think about returns denominated in something that's a little bit more pure, that actually stands for a store of value. And so it's a little bit more natural when you step outside this country that you see people thinking about Bitcoin in that way. But to me and to all of the folks in the space, it felt important to me that we lead with that ethos of trying to right set the mind to imagine that possibility. And the thing that's important here is Bitcoin, if it's meant to be productive in its own, will earn Bitcoin denominated returns, actually, just the way all assets earn yield off of their fundamental underlying denomination. And so if we do more things in kind with Bitcoin, where Bitcoin is actually the thing for which we're measuring returns by, I think that is kind of the most ideal world a treasury company could be in. When you trade options on Deribit, for example, because Deribit's a global exchange, it's priced in Bitcoin. The calls and puts that you buy is priced in the units of Bitcoin that you would buy or sell, not dollars. And I think that shows you what the future could look like for a global citizen.
The eye-opening stat that I saw that I think, like, and again, I had seen people talking about this. I think people have seen me say many times, Bitcoin's the hurdle rate. If you can't beat it, you got to buy it, the whole thing, right? The S&P 500 since 2020 has basically doubled, denominated in dollars. If you denominate it in Bitcoin, it's down more than 90%. Mm-hmm. And when I saw that, I said, wait a second, that is like so black and white. If you denominate this in dollars, you made a lot of money. Yep. If you denominate this in Bitcoin, you lost a lot of money, right? It wouldn't be the same if it was, you get 23% return versus 21. I mean, we're talking about a lot positive, a lot negative. And as I've started to talk about this publicly, I've had people, I literally had a guy recently who's an older gentleman who's got a pretty, well-respected career in finance. And he said, stop it. This is nonsense. And my takeaway from it was he's really saying that's too hard, right? Outperforming this asset that has for a 10-year compounding annual growth rate of over 85%. Yeah. That's too hard. Yeah. And I think it kind of goes back to this thing that, Bitcoiners in particular, like, you should have just bought it, right? Now that's backwards looking and with the benefit of hindsight. What I think you're saying, I think I'm saying, in this kind of Bitcoin rate of return is, well, if this is going to be that benchmark, it is hard. And so owning the asset is kind of step one to capturing the return that Bitcoin will deliver. But then if you denominate, now you start to shift your mindset into how do we generate more Bitcoin, which would be outperforming Bitcoin based on certain inputs to the formula. That's right.
I think a very intuitive example that just retail customers might appreciate is that Gemini's credit card in itself is actually a Bitcoin native financial institution service offering, because when you buy with Gemini's credit card and you're rewarded in Bitcoin as a percentage of your cash outlay, your spending outlay, you're essentially measuring the points or the value transfer that you otherwise might think of in percentage terms of dollars into Bitcoin. So when people buy Chase Sapphire cards to spend on dining and travel because it pays more than actually just buying regular goods, and it's 3% versus 1%, they play this game, right? Why do they play this game? Because they're trying to outperform something. They're trying to outperform their spending for some better offer than other credit cards based in dollars. If you're thinking about the Gemini card, yes, you're thinking about that a little bit, but what are you really betting on? You're betting on the fact that Bitcoin's going to basically double. And so whatever you thought was 3% is actually 6%, and maybe it's actually 10% and 20% years down the line. That's a Bitcoin denominated return. That's a Bitcoin denominated mindset. And I think more financial institutions can think about these as ways to lure consumers and customers to normalize that as a way of thinking. And so I'm actually just very supportive of that initiative as a retail customer myself. And I think more Bitcoin treasury companies will be involved in the dialogue of offering these types of financial services to push that narrative forward.